Hey, what's going on? Chase here at EVERBULLISH, also known as the Stock Sherpa on YouTube. Today's Thursday, April 8th. Hanging out here, my trading lab. Got my dog Sadie just came in with me. I don't know if y'all can see her. That's Sadie. She wants to be part of the team, it looks like, and we're gonna let her. She runs the house, not me. So, where was I? Oh yeah, today's Thursday. Today on my channel, I dedicate to just showing you guys a resource that I've used in the past as an advisor and that I currently use in my portfolio building as well as trading every day. I'm going to keep this real simple and short. I can go on forever about this. I'll probably will use some of this data in a big presentation on my podcast at some point. But what I want you to do is go to a great resource of www.slickcharts.com, SLICKCHARTS.com, Slick Charts. So what this is a breakdown of the components of every index. It goes into direct detail on the second by second basis of the movements of the S&P 500, the NASDAQ 100, the Dow Industrial Average, and you can actually check out and see exactly every position inside of it and exactly how much it's moving on a daily basis. If you're an advisor and you want to show your clients the exposure that they have, that they may not know they have because they own the NASDAQ, for example. Let's say we're here in Austin, there's a lot of tech guys. Let's say I have a person in my office that works for, let's say that they work, let's just be simple and say that they work for Apple. The percentage that Apple is owned in the S&P 500 is 5.76% today. So if their paycheck's coming from Apple and their stock plan is coming from Apple and their 401ks are invested in Apple and they think they're diversified just because they own the S&P 500, you may want to have that conversation with them. Second thing is if you're considering investing in indexes because they're cheap and easy, no argument from me. But what I want to point out here is that the top 5 companies, and you can see this on the website, the top 5 companies are Apple, Microsoft, Amazon, Facebook, and Google. You have over 15% of your portfolio almost in those companies. You do have 15% of your portfolio, followed by Tesla, Berkshire, JP Morgan, and Johnson & Johnson. So you don't know it, but you're overexposed to tech and underexposed to things like energy. There's no rhyme or reason to why these stocks are picked. I think understanding that is really important because the only metric involved in what you own when you buy an index is the amount of shares available times the price that they are that day, and that equals, when spread over the largest 500 companies by market cap in the on the New York Stock Exchange, that equals what you own. So one of the things I'd like to do is show this to clients and show them, look, let's go to the bottom of the S&P 500 and let's see how much money you have in the last stock of the S&P 500. This is a really cool exercise. This really blows my mind, even when I just buy a simple index to get traction on a sector. I never buy a broad-based index. I don't believe in it, but we'll just use an example here. So let's pretend that I have $1 million. I buy the S&P 500. The least amount I own of any one company is a company called News Corp Class B. So this is a B shares of a company called News Corp. And you would have 0.0086% of ownership of News Corporation Class B. If we do the math on that, you would have, on $1 million, you would have $8.60. Now, the next stock that you would own is Under Armour Class C, and you would have 0.0106%. So you'd have $10.60 of Under Armour Class C. If we go to the 400th stock that you would own inside of that, it's a company called A Biomed. Actually, let's just use 399 because it's a company you'd recognize. The 399th stock owned inside of the S&P 500 is the Whirlpool Corporation. It's 0.042, so you have $42 in Whirlpool. We go up to the 300th position. What's the 300th stock that you own? Equifax. You have 0.064%. So you only have $64 in Equifax. See what I'm doing here? The point is that it's so top weighted as an index and so broadly based on the bottom side of an index that your money's going to waste. Equifax could have a 10,000% return on the year and it wouldn't even move your portfolio, call it $5, if everything else was standard, because you don't have enough of buying power with the 500,000 of the second half of that hypothetical $1 million spread in enough concentration. The reason people use indexes typically to get rid of concentrated positions or to equal them out, but I don't believe that you have to spread it so thin that you can see through the paper, if you know what I mean here. I would rather just take that other 50 or 50% of your portfolio or 70% of your portfolio, whatever it is, and pick 20 good stocks. That way you're giving yourself a chance if one of them does better than the rest of the market. And proper diversification has been proven to be a lot less than 100 stocks. I think it's 42 is the way the math works out, but don't quote me on that. So anyway, not trying to bash anybody here, also not trying to go at anybody here. This is a great resource. This is a great resource if you're a high net worth client or a high net worth investor and you need to work out a portfolio on your own to self-direct and you want to make sure that your weightings are appropriate and you're not overexposed. It's also a great way to realize how antiquated and a lot of the pitfalls of simple index investing. I'd also recommend taking a look at the Dow. I don't think I even have to bash the Dow today, but the Dow is one of the worst indices to compare yourself to or your performance to, in my opinion, because it's not even an industrial index anymore. Looking on this website, you have to go down 8 positions before you get to Caterpillar. And then the next position is Salesforce. It's not an industrial index. It hasn't been since the 40s. I mean, there's been a bank in it almost, since the beginning of time. So it's really another tech index, believe it or not. And this one's different because it's a price-weighted index. So if you need to learn a little bit more about indexing, if you need to become a better investor and think about other resources that you can use, if you're an advisor and you want to be able to, blow up one of your clients' portfolios in front of them so that they realize the errors of their ways by listening to Dave Ramsey and Susie Orman, get at it. It'll do it, no problem. Great resource, giving it to you for free, not fluffing any of my stuff here. And it is Masters weekend, so I got Terrell Hatton winning it. I know that that's a dark horse pick. Something tells me he's going to. I hope everybody enjoys it. Enjoy your day, and all the best to everybody out there. It's Chase at EVERBULLISH, Stock Sherpa on YouTube, everbullish.com. If you want to look at any of the other things that I offer using the knowledge that I'm giving you. Thanks a lot. All the best. Let's get rich.